Accounting adjustments are made at each month end to ensure compliance with US GAAP or IFRS, depending on the accounting framework your company chooses to use. In this video, I'll walk you through 5 examples of these accounting adjustments. We will go from an easy example, such as a late invoice on an inventory purchase, all the way to a very difficult example related to costs to acquire a new customer contract. We will look at both the wrong accounting treatment as well as the correct way to record each transaction. So, if you love to learn accounting, this is going to be a very educational video for you. So let's check it out and let's dive right in. Alright, let's begin our journey here with a relatively easy example of an accounting adjustment for a late invoice on inventory purchase. So the fact patterns goes something like this. Your company ordered $300,000 worth of inventory on February 14th, 2024. The vendor terms were FOB destination. FOB is free on board, and it means that the vendor is paying for all of the shipping costs. Destination here means that the risk and title of the inventory transfers at the point where the inventory reaches its destination. Inventory was delivered on February 28th, 2024. The invoice was issued by the vendor on March 11th, 2024. All right, let's look at the wrong accounting treatment and then we'll look at the correct way. So the wrong accounting treatment is that you would record an accounts payable entry on March 11th. So the wrong accounting here is that you wait all the way till the invoice is issued on March 11th to record an accounts payable. While this violates the accrual principles of accounting because you received the inventory on February 28th, which means that you should have created an accrual on that date since the inventory transfers, the risk of the inventory and the title transfers on destination. So you received it February 28th, you create the accrual on February 28th. So the correct accounting for this would be on February 28th, you create an accrual for the inventory received by debiting inventory and crediting accrued liability for $300,000. And then when you receive the invoice on March 11th, you would release that liability or accrual by debiting it and just record the accounts payable for the $300,000. So I'm going to leave this file, by the way, that includes all of these adjustments in the description of this video. So go ahead and download the file for free. Okay, so this was an easy one. Let's move on to somewhat easy, which is number 2 on our list. All right, so for our second type of accounting adjustment, which is one level up from the previous example, we will be discussing an AR write-off or accounts receivable write-off. So here's the fact pattern. Your company records monthly accrual for allowance for doubtful accounts. The balance in the account at February end 2024 was $100,000. On March 29th, which is the following month, one of your customers, Duke Inc., files for bankruptcy. The customer has $25,000 of outstanding AR. So now you're going to have to go ahead and write off the invoices that are outstanding for this customer. So the wrong accounting will go something like going in the end of March and recording a bad debt expense as a debit and the write-off as a credit to AR $25,000. While the write-off to AR is correct, the debit to bad debt expense is incorrect. The right way to do this would be to do a debit to allowance for doubtful accounts and a credit to AR to write off the outstanding invoices. The reason for that is that this company records a monthly accrual for allowance for doubtful accounts. So here is what that would look like. Here is what they do at each month end. They generate an AR aging summary. They go through this and say, all right, for our current AR, we will accrue 1%. For 1 to 30 days late, we will record 5% of that balance and so on and so forth based on the probability from historical collection efforts and say, all right, based on that, we will record $5,640 of debit to bad debt expense and credit to allowance for doubtful accounts. So they have been building up the allowance for doubtful accounts each month, and the balance is $100,000 at the end of February. And therefore, when they book the AR write-off, it should be booked against allowance for doubtful accounts, not recording bad debt expense all over again. Okay, so this was our second accounting adjustment. And by the way, if you want to learn more about these type of accounting adjustments, they are discussed in detail in the Controller Academy, which is the accounting course that I created to show you the entire accounting cycle from scratch to run a business. Okay, great. So let's move on to the third level here, which is moderate level of difficulty. All right, here we go. So this is going up in intensity and difficulty. I hope that you're learning. If you are learning, let me know in the comment section below that you're learning, and hit like in this video so I know that you're learning something. That will encourage me to teach you more in future videos. All right, so what we got here is level 3 moderate. The example is deferred rent. Here's the fact pattern for this example. Your company signs a lease agreement for a new office space. The lease term is 12 months, which starts on March 1st, 2024. The monthly lease payment is $50,000. The first month is free, and the first payment is due April 1st, 2024. Record the rent expense for March and for April of 2024. Well, as you see in the fact pattern, March is free, and April is the beginning of the rent payments. So here is the wrong accounting for this. The wrong accounting for this is that in March 2024, you record no rent payment and no journal entry, no expense. That would be wrong. And then you wait until April, and then you record your $50,000 as a debit to rent expense and credit to cash. That will be the wrong way to deal with this. The correct way to do this is to recognize expense on a straight line basis. So you would create a deferred rent calculation. I'll show you here in a second. So here's my schedule that shows all of the month in the year from 1 to 12, the rent payment going from 0 and then $50,000 each month. And then you say, okay, my rent expense is going to be a straight line of the total amount paid for the full 12 months divided by 12. And that would be my monthly rent expense. And then you create a deferred rent liability, $45,000, and you will take that and basically phase it out over the 12 months. As you see here in the schedule, it goes down each month by $4,000. Your journal entries would be in the first month, so the first month of March 2024, a debit to rent expense of $45,000. And a creation of the deferred rent liability of $45,000, which is the difference between the cash payment and the rent expense. And then you go ahead in April and create a journal entry that says debit to rent expense, always for $45,000, the same amount. And then you will debit the liability to reduce it. So you're reducing the liability each month to phase out the liability off of your books, $4,000, and credit cash, obviously, because you're paying rent in cash in that month of April. So that would be the right way to deal with this example of free rent or rent holiday, as they call it, in the first month of the lease. All right, let's move on to number 4, which is a hard example of accounting adjustment. And things are heating up here. This is going to be a little bit more difficult, so I'm excited to talk about this one. All right, this is sales commission on a new contract. Your company sells software as a service. In April of 2024, the company signs up a new customer for a 3-year contract. The agreement is worth $9 million of expected revenue, so $3 million each year. The company paid $200,000 commission to its sales employee in connection with this agreement. Go ahead and record the commission transaction. So the wrong accounting for this is that you say, okay, I'm paying my salesperson $200K commission. I'm going to go ahead and record a debit to commission expense and a credit to cash. Right? This is wrong because under ASC 340, accounting for revenue from contracts with customers, the incremental cost of obtaining a contract should be recognized as an asset. The incremental costs here, these are the costs that the reporting entity would not have incurred if the contract had not been obtained. So these are costs that you're only incurring if the contract is obtained. If the contract is not obtained, you're not incurring the costs. Something that will be the opposite of this is that, let's say you're spending on advertising. If you're spending on advertising, you're spending that money regardless you're obtaining a contract with customers or not, right? So that would be expense as incurred, it would be a period cost. However, this one here has to be capitalized because this is related to what we call an incremental cost in obtaining a new contract. So the debit will be capitalized commission asset, and the credit will be to cash. And that capitalized asset will be amortized on a straight line schedule starting when you begin to generate revenue from this customer, so that you're matching your revenue with expenses each period. And there is actually a very good diagram by PwC, so I'm going to show it up here on the screen. This diagram summarizes this process, the thought process of whether you would capitalize or expense the cost associated with the contract. So it says, did the company incur costs in its effort to obtain a contract with the customer? Well, yes. This is what we said here. We are spent $200,000 in sales commission. Are these costs incremental, only incurred if the contract is obtained? Well, you have to then look at the agreement with the employee, the commission agreement, and it says, you would only earn commission if you sign up a new customer, which is the case here. So the answer is yes to this case. The next question will be, does the reporting entity expect to recover these costs? Recovering the cost here means that you will be generating revenue from this contract with the customer. Do you expect, in this case, to generate revenue? Well, yes, we said that we expect to generate $9 million from this customer over 3 years. Then the next question becomes, is the amortization period 1 year or less, or over 1 year? In this case here, it's over 1 year of amortization, because the contract with the customer is 3 years. Then it's going to be recognized as an asset. See here, the diagram will show you that if the answer is no to any of these questions, you might have to just recognize the entire commission as an expense in the month and be done with it. I'm going to leave a link to this very helpful PDF from PwC that discusses the entire ASC 340, the revenue under contracts from customers. I'll leave a link so that you can go ahead and check it out. It's pretty long. It's about 250 pages. You don't have to read all of it. You can just take a glance and use the find function with Control F to find certain things that you're looking for in the file. Okay, so now we move on to our last example here, or very hard example. And this is very hard depending on where you are. If you are a new accountant, this is going to be pretty hard. If you're a seasoned accountant, this could be pretty easy for you. So it's a buyout of a legacy vendor contract. Let's go through the fact pattern here. Your company sells website hosting services. In April 2024, the company signs up a new customer for a 3-year contract for a total of $2 million expected revenue. Part of the agreement, your company as the new supplier will pay the customer $500,000 to satisfy the previous provider early exit fee. Record the early exit fee. So what we're saying here is that our company, becoming the supplier of a new customer, is having to pay that customer for the early exit fee of their previous supplier, right? So their previous supplier wants to charge them, or by the contract has to charge them $500,000 to exit the contract early. And we're saying, for us to become your new supplier, to be nice, we'll go ahead and pay the $500,000 for you. To record that $500,000, the wrong accounting treatment for it would be to record the entire amount as a period cost in the current period, debit $500,000 cost of early exit fee, and a credit to cash $500,000. The correct way to record this would be very similar to our previous example. So the correct way is going to be a debit to a capitalized buyout asset. So you're going to create an asset on the books for $500,000 and credit to cash. And this is because, looking again at that diagram the same way, we have to ask ourselves the same question. Is the cost to obtain a new customer contract? Yes. Is the cost incremental? Yes, because we only will pay it if we get that contract. Is it going to be expected to recover these costs? Yes, we expect to create revenue from this customer. Is the amortization period over 1 year? Yes. So then you create an asset under ASC 340. So you amortize that asset based on a straight line schedule, based on the period at which you expect to generate revenue, or the term of the contract with this customer. Let me know if you like this kind of videos in the comment section below, so I can make more of these real life examples for you. Again, if you didn't hit the like button already, go ahead and smash it right now, and I'll see you in the next video.